Something has shifted. Not overnight, not suddenly. But if you've been watching the commodity markets, the debt markets, the currency markets, you know what I'm talking about. The landscape that existed 2 years ago doesn't exist anymore. And silver, the metal most investors ignore, most analysts dismiss as too volatile, most portfolios overlook entirely, is sitting at the center of a convergence that hasn't happened in decades. This isn't about hype. This isn't about getting rich quick. This is about understanding what happens when industrial demand, monetary uncertainty, and supply constraints meet at the same intersection. And that intersection is here, right now, in 2026. If you hold silver, this video will help you understand what you're sitting on and how to think about it rationally. If you don't hold silver, this video will give you the framework to decide whether it belongs in your portfolio, and if so, how to approach it with discipline. Because what's happening right now isn't just a trade, it's a cycle. And cycles reward those who understand them, not those who chase them. And let's talk about why silver might not just be a commodity story this year. It might be the commodity story. We've heard this before, haven't we? Silver's moment has arrived. It's been said in 2011. It's been said in 2020. And each time silver rallied hard, then collapsed harder, leaving retail investors burned and professionals shaking their heads. So why should 2026 be any different? Because the fundamentals aren't the same, the macro environment isn't the same, and most importantly, the supply-demand equation has fundamentally changed in ways that can't be reversed quickly. Let's start with what matters most, industrial demand. Silver isn't just a monetary metal anymore, it's the backbone of the green energy transition. Every solar panel requires silver. Every electric vehicle uses significantly more silver than traditional vehicles. With the semiconductor industry, artificial intelligence infrastructure, 5G networks, all of them need silver in quantities that dwarf historical consumption. In 2023, industrial demand for silver exceeded 1 billion ounces for the first time in history. In 2024, it climbed higher, and the projections for 2026 and beyond show no signs of slowing. This isn't speculative. This is contracted, planned, budgeted industrial use. Now, layer on top of that something else. Supply isn't keeping pace. Silver mine production peaked years ago. Most silver comes as a byproduct of copper, lead, and zinc mining. You don't just turn on a silver mine when prices rise. It takes years, capital, permits, infrastructure. And here's the part most people miss, the structural deficit. For the past 3 years, the world has used more silver than it produced. That gap has been filled by above-ground stocks, recycling, and investor selling. But those buffers aren't infinite. When a market shifts from surplus to deficit and stays there, something has to give. Either demand destroys itself through higher prices, or supply miraculously appears, or prices adjust to balance the equation. In silver's case, demand isn't discretionary. You can't build a solar farm without silver. You can't manufacture semiconductors without it. This is inelastic, structural demand. That's the industrial side. Now let's talk about the monetary side. Central banks are trapped. That's not hyperbole, that's math. Global debt has exceeded 300% of GDP. Government deficits in major economies are structural, not cyclical. The United States alone is adding trillions to its debt load annually, with no political will or mechanism to stop it. Interest rates matter more now than they have in decades. And here's the paradox. Rates can't stay high without breaking something, but they can't fall too fast without reigniting inflation. We saw what happened in 2022 and 2023 when central banks raised rates aggressively. Bond markets convulsed, banks failed, real estate buckled. And yet inflation, while cooler than its peak, remains stubbornly above target in most developed nations. Now we're in 2026. Central banks have paused, but they haven't solved anything. They've merely paused the pain. And markets know this. That's why volatility hasn't disappeared. That's why investors are quietly rotating into real assets. When confidence in currency stability erodes, even slightly, precious metals start looking different. Not as speculation, as insurance. As a hedge against outcomes nobody wants but everyone knows are possible. Silver benefits from this in a unique way. It's cheaper than gold, more accessible to average investors, and it carries that industrial demand story on top of the monetary one. It's a hybrid. And in an uncertain environment, hybrids become attractive. Consider what's happened to currency markets over the past 18 months. The dollar has remained strong, but that strength is built on confidence, not fundamentals. Other currencies, the yen, the euro, the pound, have struggled with their own debt and growth challenges. Emerging market currencies have faced repeated pressure. When faith in paper currencies weakens, even at the margin, hard assets catch a bid. And silver, priced in dollars, becomes relatively more attractive to non-dollar holders. This isn't theory. We saw this exact dynamic play out in previous cycles. The difference now is that the monetary uncertainty is global and structural, not isolated and cyclical. Silver has a reputation problem. And frankly, it's earned it. It's been the realm of conspiracy theorists, doomsday preppers, and online forums shouting about manipulation and moonshots. That noise has driven serious investors away for years, and I understand why. But here's what serious investors miss when they dismiss silver entirely. The noise doesn't change the fundamentals. The fact that uninformed speculators get excited about silver doesn't make the supply deficit less real. It doesn't make industrial demand disappear. It doesn't make the macro environment irrelevant. The mistake many people make is confusing the messenger with the message. Yes, there's hype around silver. Yes, there are people making outlandish predictions. But underneath that noise, there's a genuine, measurable, verifiable shift happening in the commodity itself. Silver is volatile. That's not a secret. Its price can swing 5% in a day, 20% in a month. That volatility scares institutional money. It burns retail traders. And it creates a self-fulfilling perception problem. Silver is too risky, so it gets ignored. So it remains underowned. So when it does move, it moves violently, which confirms everyone's bias that it's too risky. But volatility isn't the same as risk. Risk is permanent loss of capital. Volatility is price fluctuation. And for patient investors who understand cycles, volatility is opportunity, not danger. Another misunderstanding. People compare silver to gold and assume they're interchangeable. They're not. Gold is a pure monetary asset. It has minimal industrial use. Its price is driven almost entirely by sentiment, real rates, and central bank behavior. Silver is different. It has monetary properties, yes, but 60% of its demand is industrial. That means silver responds to both monetary factors and economic growth factors. It's more complex. And that complexity creates opportunity for those who understand it. When the economy is strong and industrial demand is rising, silver benefits. When monetary uncertainty is high and investors seek safety, silver benefits. The rare environment where both happen simultaneously, that's when silver outperforms everything. We might be entering that environment now. Let's look at what history teaches us, because markets don't repeat, but they rhyme. In the 1970s, silver went from under $2 per ounce to nearly $50 at its peak in 1980. That wasn't speculation alone. It was inflation, currency devaluation, oil shocks, geopolitical tension, and a commodity supercycle all happening at once. Silver responded accordingly. Then came the crash. By 1982, silver had given back most of those gains. Why? Because the fundamentals that drove it higher reversed. Paul Volcker raised interest rates to 20%. Inflation was crushed. The dollar strengthened. Commodity demand collapsed. Lesson: silver moves in cycles, and those cycles are driven by macro conditions, not hope. Fast forward to the 2000s. From 2003 to 2011, silver rallied from $4 to $49. Again, this wasn't random. We had low interest rates post-288, massive quantitative easing, a weak dollar, strong emerging market growth, and a commodity boom driven by China's industrialization. Then came the reversal. The Federal Reserve signaled tightening. The dollar strengthened. Commodity prices rolled over. Silver crashed to $14 by 2015. Lesson repeated. Silver is a macro asset. It responds to big forces, not small narratives. In 2020, we saw another spike. Silver went from $12 in March to $30 by August. Why? Pandemic stimulus, near zero rates, currency creation on an unprecedented scale, and supply chain disruptions. Then, as inflation surged and central banks tightened, silver corrected, spending 2022 and 2023 consolidating. Now we're in 2026. And the setup looks different from 2015 or 2018. It looks more like 2003 or 2009, a period where macro forces are aligning, not diverging. Cycles in commodities typically last years, not months. The move from 2003 to 2011 took 8 years. The move from 1971 to 1980 took 9 years. We're potentially early in a new cycle, not late. That matters for psychology. Many investors, burned by previous false starts, assume every silver rally is a trap. They've been conditioned to sell strength, not hold through it. And that creates opportunity for those who understand the difference between a tactical bounce and a structural move. Let me be specific about what's different this time, because specifics matter. Global silver mine production has been essentially flat since 2016. We're producing roughly 800 to 850 million ounces per year. And that number isn't growing meaningfully. Most of the easy-to-mine silver has been found. New discoveries are deeper, lower grade, more expensive to extract. Meanwhile, demand has exploded. Solar panel installations are projected to double again by 2028. Electric vehicle adoption is accelerating faster than most forecasts predicted. The infrastructure required for AI and data centers uses significant silver in connectors, switches, and circuits. In 2025 alone, industrial demand consumed nearly 700 million ounces. Investment demand added another 200 million. Jewelry and silverware took roughly 200 million. That's over 1.1 billion ounces of demand, against 850 million ounces of new supply. The gap was filled by selling from above-ground stocks and recycling. But here's the problem. Above-ground stocks are harder to measure and aren't infinite. And recycling silver from industrial applications is expensive and inefficient compared to other metals. What this means is simple. If demand stays strong and supply stays flat, the market has to incentivize either demand destruction or new supply. Both require significantly higher prices than we've seen recently. Now, I'm not predicting a price. I'm explaining a mechanism. Markets clear? They always do. But the clearing price might be much higher than current levels if the fundamentals we're seeing are sustained. Another shift that's underappreciated: China. For years, China was a silver exporter, dumping supply into global markets. That's reversed. China is now a net importer of silver, driven by its domestic solar and EV industries. That's a structural change that removes a major source of supply from the global market. Add to this the geopolitical dimension. Silver, like many critical minerals, is concentrated in specific countries. Mexico, Peru, China, and Chile account for the majority of production. Any disruption, political instability, export restrictions, mining strikes, immediately impacts global supply. We've already seen flashes of this: export quotas, environmental shutdowns, labor disputes. None of this is going away. It's the new normal for resource markets. Something else is changing, and it's harder to measure, but equally important: how investors think about commodities. For the past 15 years, since the 2008 financial crisis, we've been in an era dominated by financial engineering. Stocks outperformed everything. Technology led the market. Growth beat value. Intangible assets, data, software, networks, were prized above tangible assets. Commodities were left behind. Oil, copper, grains, metals, all of them underperformed equities by wide margins. Capital fled the sector. Mining companies couldn't raise money. Exploration budgets collapsed. An entire generation of investors learned to ignore physical assets. But cycles turn, and we're seeing early signs of a turn now. Inflation reminded people that physical goods matter. Supply chains reminded people that resources aren't infinite. Geopolitical tension reminded people that access to critical materials is strategic, not guaranteed. Institutional investors, pension funds, sovereign wealth funds, they're quietly adding commodity exposure. Not aggressively, not loudly, but steadily, because they've run the numbers. And the numbers show commodities are historically cheap relative to financial assets. Silver benefits from this rotation in two ways. First, as a commodity with supply constraints, it catches the general bid toward resources. Second, as a monetary asset, it catches the specific bid toward inflation hedges and dollar alternatives. Retail investor sentiment is also shifting, but more slowly. Most retail investors are still scarred by past silver volatility. They remember getting burned. They're skeptical. And that's actually healthy. When everyone is skeptical, that's often when opportunity is greatest. The crowd isn't in silver yet. Not like 2011. Not like early 2021. That's a positive sign, not a negative one. When an asset is underowned and fundamentals are improving, that's when patient capital gets positioned, not when everyone is excited. Sentiment is a lagging indicator, not a leading one. By the time sentiment is universally bullish, the easy money has been made. Right now, sentiment is cautiously optimistic at best, outright dismissive at worst. That's the environment where disciplined investors build positions. If you're already holding silver, whether physical metal, ETFs, or mining stocks, let's talk about how to think clearly right now. First, understand what you own and why you own it. If you bought silver as a short-term trade, that's one strategy. If you bought it as a long-term inflation hedge, that's another. If you bought it because you believe in the industrial demand story, that's a third. Your time frame and thesis determine how you should react to volatility. If you're holding silver as a long-term position, recent consolidation and volatility shouldn't concern you. In fact, it's healthy. Markets that go straight up are fragile. Markets that consolidate, retest levels, shake out weak hands, those are markets building a foundation for sustained moves. What matters for long-term holders is whether the fundamentals remain intact. And as of early 2026, they do. The supply deficit hasn't been resolved. Industrial demand hasn't slowed. Monetary uncertainty hasn't disappeared. If anything, all three have intensified. That said, holding silver is not passive. You need to stay informed. Not obsessively watching prices every hour, but understanding the macro environment. Are central banks tightening or easing? Is industrial demand growing or stalling? Are there major supply disruptions or new discoveries? Long-term holdings require long-term thinking. That means tuning out daily noise. It means not panicking when silver drops 10% in a week. It also means not getting euphoric when it rises 15%. Emotional control separates successful commodity investors from those who get shaken out at the worst times. Consider your position size. If silver is 5% of your portfolio, a 20% move in either direction is a 1% impact on your total wealth. That's manageable. If silver is 50% of your portfolio, that same move is a 10% impact. That's stress. That's poor risk management. The right allocation depends on your risk tolerance, time horizon, and conviction. But as a general principle, no single asset, no matter how compelling, should dominate your portfolio. Diversification isn't about reducing returns. It's about surviving the journey. If you're sitting on gains, consider whether those gains have changed your risk profile. A position that was 5% of your portfolio that has doubled is now a larger percentage. Does that still fit your plan? Maybe yes, maybe no. But the question needs to be asked consciously, not ignored. For those holding physical silver, remember the difference between investment silver and collectibles. Bullion coins and bars have minimal premium over spot price. Numismatic coins or rare collectibles trade at large premiums that may not move with the silver price. Know what you hold. Patience is your advantage here. The crowd trades on emotion. You have the luxury of time if you choose to use it. The fundamentals are playing out over months and years, not days. Your job is to stay rational while others swing between fear and greed. If you don't currently hold silver but you're considering it, you're in a different position, and you need to think differently. First question, does silver fit your portfolio at all? Not every investor needs commodity exposure. If you're young, have a long time horizon, can tolerate volatility, and want diversification beyond stocks and bonds, then silver might make sense as a small allocation. If you're conservative, close to retirement, or have low risk tolerance, silver might not be appropriate regardless of the fundamentals. Know yourself before you know the asset. Assuming silver does fit, the next question is, how much? We've already covered this, but it bears repeating. A small allocation, 3% to 5% of total portfolio, gives you exposure to the upside without creating undue risk. A larger allocation requires stronger conviction and deeper research. Timing matters, but not in the way most people think. You're not trying to catch the bottom. You're trying to enter at a reasonable price within a bigger cycle. Silver at $28 might be a good entry if it's going to $40. Silver at $32 might be a bad entry if it's going back to $24. But nobody knows the future path with certainty. What you can do is average in over time. Rather than committing all at once, build your position gradually. Buy a portion now, another portion in a month, another in 3 months. This reduces the risk of entering at a local top and smooths your average cost. Consider the vehicle carefully. Physical silver, coins, and bars gives you direct ownership and no counterparty risk, but comes with storage considerations and liquidity challenges. Silver ETFs offer liquidity and convenience, but involve trusting an institution. Silver mining stocks offer leverage to the metal price, but come with company-specific risks. Each has trade-offs. The right choice depends on your situation. Many investors use a combination, some physical for security, some ETFs for liquidity, some miners for upside leverage. Do not, and I cannot stress this enough, do not enter silver with money you need in the near term. This is a volatile asset. It can drop 15% while you're holding it, even if the long-term thesis is correct. If you can't psychologically or financially handle that volatility, you'll sell at the wrong time. Silver is not a get-rich-quick scheme. It's not a lottery ticket. It's a commodity with real supply and demand dynamics, influenced by macro forces that tends to move in multi-year cycles. Approach it with the same seriousness you'd approach any other investment. Research before you commit. Understand what drives silver prices. Read about industrial demand. Study past cycles. Watch how silver responds to changes in interest rates, inflation data, and currency movements. Education reduces emotional decision-making. Let's be direct about the ways people lose money in silver, because avoiding mistakes is often more important than finding opportunities. Do not chase price momentum. When silver is surging and everyone is talking about it, that's often the worst time to enter. The best time to buy an asset is when it's boring, hated, and ignored. The worst time is when it's exciting, popular, and everywhere on social media. Do not use leverage or margin unless you're an experienced trader who understands the risks. Silver is volatile enough without adding borrowed money. Leverage can turn a 20% correction into a total loss. It can force you to sell at the worst possible time. It transforms investing into gambling. Do not follow tips or hot takes from online forums or social media influencers. The loudest voices are often the least informed. The people screaming about silver manipulation or predicting $100 silver next month are not your friends. They're either delusional or trying to pump their own positions. Do not invest emotionally. If you're buying silver out of fear or anger at the financial system, you're not investing. You're venting. If you're buying because you're excited by recent gains, you're not investing. You're chasing. Good decisions come from analysis, not emotion. Do not put all your money into any single asset, especially not a volatile commodity like silver. Diversification isn't sexy, but it works. It keeps you in the game when individual bets go wrong. It lets you sleep at night. Do not expect silver to move in a straight line. There will be corrections. There will be periods where it consolidates or even declines while the fundamentals remain bullish. That's normal. Markets don't move in straight lines. If you can't handle that reality, you shouldn't own volatile assets. Do not confuse a position in silver with a complete financial plan. Silver might play a role in your portfolio, but it's not a substitute for emergency savings, retirement accounts, insurance, or diversified investments. It's one piece, not the whole picture. Do not sell in a panic when prices drop. This is how retail investors consistently lose money in commodities. They buy when prices are rising, they panic when prices fall, they sell at a loss, and then they watch the asset recover without them. Break this cycle by deciding in advance what would change your thesis, not what would scare you. Do not ignore tax implications. In many jurisdictions, precious metals are taxed as collectibles at higher rates than stocks or bonds. Understand the tax treatment before you trade. It can significantly impact your after-tax returns. Do not assume the past predicts the future. Yes, we can learn from history. Yes, cycles tend to rhyme, but every cycle is different. The fundamentals that drove silver in the 1970s aren't identical to today. Use history as a guide, not a guarantee. Silver doesn't exist in isolation. It's part of a broader commodity complex, and that complex is part of an even broader economic structure. Understanding the bigger picture helps you think clearly about silver specifically. We're potentially entering a decade that looks very different from the last one. The 2010s were defined by disinflation, low rates, globalization, and financial asset dominance. The 2020s appear to be shaping up differently. Persistent inflation pressures, higher rates, deglobalization, and a rotation toward physical assets. If that thesis is correct, and it's still unfolding, commodities as a whole should outperform. Not every year, not in a straight line, but over the decade. We should see capital flow back into resources that were starved of investment for years. Silver benefits from this in multiple ways. As a commodity, it catches the general bid toward resources. As an industrial metal, it benefits from green energy and technology trends. As a monetary metal, it benefits from currency uncertainty and inflation hedging. The green energy transition alone represents a massive tailwind for silver demand. Solar panels, EVs, battery technology, grid infrastructure, all of it requires silver in increasing quantities. And unlike demand for silver jewelry or photography, which collapsed with digital cameras, industrial demand is structural and growing. Governments worldwide have committed to carbon reduction targets. Those commitments require trillions in investment over the next 20 years. Much of that investment flows into silver-intensive technologies. This isn't speculation, it's policy, it's budgeted, it's happening. At the same time, the mining industry faces challenges that limit supply growth. Ore grades are declining, discoveries are fewer and smaller, environmental regulations are stricter, community opposition is stronger, labor costs are rising, capital is harder to raise. All of this means new supply comes online slowly and expensively. The combination, rising demand, constrained supply, is textbook economics. Eventually, price has to adjust to balance the market. The question isn't if, but when and how much. Now, none of this means silver goes straight up. Markets are messier than theory. But it does mean the bias over the medium term is likely higher, not lower. We can't talk about silver without understanding the monetary backdrop, because monetary policy drives investor behavior, which drives capital flows, which drives prices. Central banks spent the last 15 years suppressing interest rates and expanding money supply. That created the everything bubble. Stocks, bonds, real estate, even cryptocurrencies. Financial assets surged while real assets lagged. Now we're in a different phase. Inflation forced central banks to raise rates aggressively. That broke things. Bank failures, pension crises, real estate corrections. But inflation hasn't been fully conquered. It's moderated, but it remains above target in most economies. Central banks are stuck. They can't keep rates high without causing more breakage. But they can't cut too much without risking an inflation resurgence. They're navigating a narrow path, trying to achieve a soft landing that history suggests is rare. What does this mean for silver? It means uncertainty, and silver thrives in uncertainty. When investors trust central banks and believe in currency stability, they hold cash and bonds. When that trust erodes, they look for alternatives. Gold is the traditional alternative. Silver is the more accessible one. We're not at a crisis point yet. But confidence is fragile. Any shock, a banking crisis, a sovereign debt crisis, a geopolitical event, could trigger a rapid shift in sentiment. And in that environment, silver would likely surge as investors seek tangible assets. Even without a crisis, the slow erosion of purchasing power through persistent, moderate inflation creates a steady tailwind for hard assets. If inflation averages 3% annually, the dollar loses 25% of its value over a decade. Silver, as a real asset, tends to maintain purchasing power over time. This isn't about doom and gloom. It's about probabilities. The probability that we muddle through with moderate inflation and modest growth is high. The probability that silver benefits from that environment is also high. Professional investors think in terms of risk-adjusted returns, not just returns. They ask, what can I make, what can I lose, and what's the probability of each outcome? Applied to silver, if the fundamentals play out as expected, what's the upside? If they don't, what's the downside, and what factors would signal which path we're on? Upside scenario. Industrial demand continues growing. Supply remains constrained. Monetary uncertainty persists. Silver reprices significantly higher over several years. Holders earn strong returns. Those who size positions appropriately and stayed patient do well. Downside scenario. A major recession crushes industrial demand. Central banks successfully engineer disinflation. The dollar strengthens aggressively. Silver corrects sharply. Holders experience losses, especially if over-allocated or using leverage. Most likely scenario, something in between. Silver consolidates, trends higher over time with significant volatility, and rewards patient holders while punishing traders. Risk management means preparing for all three. It means position sizing that lets you survive the downside without panic selling. It means time horizons that let you ride out volatility. It means diversification that ensures silver is one bet among many, not your only bet. It also means having predefined rules. What would make you sell? Not fear, but actual fundamental changes. If industrial demand rolls over, that's a signal. If a massive new supply source comes online, that's a signal. If central banks engineer a sustained, strong dollar with falling inflation, that's a signal. Knowing in advance what would change your thesis prevents emotional decision-making in the moment. Write down your thesis. Write down what would invalidate it. Refer back when volatility hits. This is how professionals stay disciplined. They treat investing like a process, not a feeling. They update their views based on evidence, not emotion. And they accept that being wrong is part of the game, not a personal failure. We've covered a lot of ground. The macro environment, the supply-demand story, historical cycles, investor psychology, risk management, what to do and what to avoid. Let me bring it back to the core message. Silver in 2026 represents a potential opportunity driven by real, measurable fundamentals. It's not certain. Nothing in markets is certain. But the probability is skewed in favor of higher prices over the medium term if current trends persist. For those who already hold silver, the message is simple. Stay patient. Stay informed. Tune out noise. Remember why you bought. Let the fundamentals play out. Don't let short-term volatility shake you out of a long-term position. For those considering silver, the message is do your homework. Understand what you're buying and why. Size your position appropriately. Use discipline to average in overtime rather than trying to time a perfect entry. And be prepared for volatility. For everyone, the broader message is about how to think during periods of uncertainty. Markets move in cycles. Commodities move in cycles. Investor sentiment moves in cycles. Those who understand cycles and position accordingly do better than those who react emotionally to headlines. Silver isn't the only opportunity in markets. It might not even be the best opportunity. But it's an interesting one worth understanding, one worth considering as part of a diversified approach. This moment, early 2026, might be looked back on as a turning point. Or it might be another false start. We won't know for months or years, but that's the nature of investing. We make decisions with incomplete information, manage risk, and let probabilities play out over time. What I can tell you with confidence is this. The forces driving silver are real. Industrial demand is real. Supply constraints are real. Monetary uncertainty is real. These aren't narratives. They're facts that can be measured and tracked. How those facts translate into price is uncertain. Markets are complex, sentiment-driven, and influenced by countless factors we can't predict. But understanding the fundamentals gives you an edge. It lets you think clearly when others are confused. It lets you act with conviction when others are paralyzed by fear or greed. The investors who do well over decades aren't the ones with perfect timing. They're the ones who understand value, manage risk, and stay disciplined through cycles. They don't swing for home runs. They don't panic in corrections. They think in years, not days. Silver rewards that kind of thinking. It punishes impulsiveness, leverage, and emotion. It rewards patience, preparation, and perspective. So whether you hold silver or you're considering it, approach it thoughtfully. Not as a trade, but as a position. Not as a gamble, but as a calculated exposure to specific macro and industrial trends that appear to be in the early stages of a multi-year development. Stay curious, stay educated, stay rational. And remember that the goal isn't to predict the future perfectly. It's to position yourself intelligently for a range of possible futures, manage risk along the way, and maintain the emotional composure to stick with your plan. The commodity markets are cyclical. The monetary system is evolving. Technology is demanding more resources. Supply chains are being restructured. All of this creates opportunity for those paying attention. Silver might be that opportunity, or it might be one of several. But either way, understanding what's happening beneath the surface, the real forces, not the hype, is what separates thoughtful investors from the crowd. Thank you for taking the time to think through this with me. Stay disciplined, stay informed, and remember, in investing, preparation and patience matter more than prediction. The 2026 commodity story is still being written. Whether silver takes the throne remains to be seen, but the conditions for it to do so are as strong as they've been in years, and that's worth understanding.